Did the Australian government just rig the property market with its new 5% deposit scheme? To break down the federal government's new 5% deposit scheme for first home buyers, I will explain what this scheme is, who wins, who loses, and the hidden consequences most people aren't talking about. By the end of this video, you will know if this 5% deposit offer is a good ticket to home ownership or a potential trap for the property market. Stick around for a bonus tip at the end, especially if you are thinking about using this scheme. So, what exactly is this 5% deposit scheme? The Australian government has introduced an expanded first home buyer guarantee that lets eligible buyer purchase a home with only 5% deposit. Starting October 1st, 2025, any first home buyer can use this scheme to get into the market with a tiny down payment. How is that possible? Essentially, the government will guarantee the other 15% of the typical 20% deposit, so banks won't require you to pay expensive lenders' mortgage insurance on a 95% of loan. In plain English, the government is backing your loan so you can buy sooner with less money upfront. And unlike the old version of the scheme, there are no caps on the number of spots or income limits to qualify. They have even raised the property price limits significantly. For example, in Sydney, the price cap will jump from $900,000 to $1.5 million. That means more homes, even with $1.5 million in Sydney, are on the table for first home buyers using a 5% deposit. So, practically, a huge hurdle is being removed. The median Australian house costs about $844,000, and normally a 20% deposit would be $168,000, out of reach for most. Under this scheme, 5% is only about $42,000, an amount that used to be a full 20% deposit back in 2002. It's like turning back the clock on the deposit requirement by 2 decades. No wonder the policy is causing such a buzz. Why a 5% deposit is a big deal? For home buyers, especially those currently renting, these schemes sounds like a dream come true. Here are the major benefits. Buy sooner, stop renting. With only 5% needed, you can buy years earlier instead of slowly saving 20% or 10%. Government estimate says this cuts several years off the time it takes to save a deposit. That means fewer years paying rent and more time paying off your own home rather than your landlord's. Treasury figures suggest those who use the scheme will save tens of thousands of dollars in rent by getting into home soon. No LMI cost. LMI, lender's mortgage insurance, which can add tens of thousands to your upfront cost. Under this scheme, LMI is waived because the government is covering that risk. That's a direct savings. For example, on a 600,000 home, avoiding LMI might save you around 10 to 20,000 in fees. Across all buyers, the government expects first home buyers to avoid about $1.5 billion in mortgage insurance cost in just the first year of the scheme. Serious money that stays in your pocket or goes into your home loan instead. More choice of homes. By raising the price cap and removing the income limits, the scheme isn't just for a narrow group anymore. All first home buyers are eligible now. Whether you're on an average income or a higher income, you can look at homes worth up to $1 million or more depending on the city without losing the guarantee. This opens the door to better quality or better located properties and previously were above the old cap. It's not just cheap units in the city fringe. You might snag a decent house closer to where you actually want to live. Previously, many would-be first home buyers were stuck renting the saving forever, while investors who often use equity and pay 20% down or more or less keep buying properties. This scheme could level the playing field a bit. One industry expert noted that requiring huge deposits and LMI was effectively facing more young people to rent longer, which drove up rents and boosted returns for landlords. By removing these barriers, big deposits and LMI, the government is giving first-timers a better shot at competing in the market. In other words, property investors no longer have quite the same advantage of young buyers being sidelined. Even the Housing Industry Association suggested that enabling more first-home purchases could ultimately increase housing supply, since first home buyers often buy new builds, which they believe will, in few years, help balance out prices and rental pressures. An entire operation of young Australians has felt locked out of the housing market. The housing minister, Claire O'Neill, said it's just not right. The people have been saving for decades while paying off someone else's mortgage. And this policy is about backing a new generation of first home buyers. There's a real emotional pull here. The Australian dream of owning a home might finally be within reach for those who felt left behind. For many renters, just knowing the scheme exists could motivate them to keep saving, knowing they don't need to hit an impossible 20% target. The possible catch, the hidden downside, before we pop the champagne, we need to look at the other side of the coin. Policies like this can have side effects, some unintended and some very predictable. Here are some key concerns experts are raising. House prices may rise. The biggest worry is that easier buying will push on demand and therefore push up prices. The government's own treasury modeling claims that impact on prices will be minimal, roughly 0.5% increase over 6 years due to the scheme, but many economists aren't so sure. Independent analysis forecasts a much larger effect. One report by Lateral Economics predicts property values could jump 3.5% to 6.6% higher in 2026 alone because of the influx of new buyers. Some even warn of a fueled by this scheme combined with falling interest rates. Bottom line, by helping tens of thousands of extra people buy quickly, the policy might bid up the prices of homes, ironically making them even less affordable for those still trying to buy. Lower income buyers could be priced out. Wait, how could a first home buyer policy price out first home buyers? This sounds counterintuitive, but if the scheme triggers a surge in the competition for entry-level properties, not everyone wins. Those with lower incomes or smaller budgets might actually find themselves outbid and worse off. In fact, that same report estimated around 605,000 lower income first home hopefuls will be priced out in the first year as wealthier buyers, now unfettered by income caps, swoop in with their 5% deposits and drive up prices. It's a policy designed to help the little guy could edge some of them out, at least in the short term. More debt, less equity. Buying with 5% down means taking on a 95% mortgage. That's a heavy debt. More debt, less equity. Buying with 5% down means taking on a 95% mortgage. That's a heavy debt load related to your home's value. If a property value dipped even slightly, new buyers could slip into negative equity, owning more than the house is worth very quickly. And even if prices don't fall, a bigger loan means higher monthly repayments in interest costs over the life of the loan. Yes, you stop paying rent, but you start paying a larger mortgage. Homeowners will need to budget carefully for that, especially if interest rates ticks up in the future. It's permission to take on a lot of debt. Taxpayers' risk. There's also a hidden risk to taxpayers. If a bunch of these 5% deposit loans go bad, say due to an economic downturn or job losses, the government and by extension taxpayers could be holding the bag for the guaranteed portion. Now, no one expects a mass default. Banks will still check the borrowers can afford the loan, but the risk isn't zero. Essentially, the public is collectively insuring these high-risk loans instead of the borrower paying NMI to an insurer. That's fine if most people meet their repayments, but it's something to watch in the long run. Demand versus supply, a band-aid solution. Critic economists argue that schemes like this treats the symptom, not the cause of housing unaffordability. Australia's core problem is the housing supply hasn't kept up with demand. By enabling buyers with low deposits, the government is boosting demand even more, which without sufficient new housing simply fuels higher prices. Eslek points out that for years, various policies, first home buyer grants, stamp duty cuts, investor tax breaks, have pumped up demand, and unsurprisingly, house prices kept rising. He suggests that while politically popular because existing homeowners vote for policies that keep values high, these demand side boosts make home ownership harder in the long term by inflating prices. So the 5% deposit scheme might help some individuals now, but it could worsen the overall affordability crisis if not paired with serious efforts to build more homes. For the record, the government has a separate $43 billion housing plan to increase supply, but those new houses won't pop up overnight. In the words of one housing advocate, the 5% deposit idea is not a solution to the affordability crisis. It helps a lucky subset of people, but doesn't fix housing for everyone. Price of avoiding NMI. Here's a starting fact. By avoiding NMI, buyers can save maybe $20,000 to $30,000, but the surge in demand could add far more to the purchase price. On a $700,000 home, not having to pay NMI might save around $21,000 to $28,000, but the increased competition could drive the price up to $37,000 to $69,000 higher than it could have been. In other words, you avoid a fee but end up paying a high price for house itself. This is a classic outcome when new buying power is introduced into a market with tight supply. Great for sellers and existing property owners, not as great for new buyers collectively. Investment properties not included. This isn't exactly a downside, but important to clarify. If you are an aspiring investor thinking you can snag an investment property with 5% deposit guaranteed by the government, that's not the case. You are generally having to live in the property, at least initially, to qualify. So this scheme is not designed to help you buy your third rental. It's to help renters buy their first residence. Some in the real estate industry like this because it targets owner-occupiers rather than giving yet another leg up to investors. But if you are a property investor, you might feel left out. Impact on investors and renters. Property investors and current renters will feel its ripple effects too. For property investors, if you are already owning a property, a surge of first-home buyers with government-backed For property investors, if you already own property, a surge of first-home buyers with government-backed loans could increase demand in the property market, especially in the entry-level segment. In the short term, that means your property value might rise. Good news for your equity. Investors holding starter homes or units might see more competition from cashed-up or rather government-backed first-timers. On the flip side, if you are looking to buy additional investment properties, be prepared to potentially pay more as prices respond to the influx of new buyers. Analysts predict the scheme will add thousands of extra buyers to the market. One estimate is an increase of about 3.8% to 7.1% in the annual buyer demand, which is 20,000 to 39,000 extra buyers per year. Additionally, if some of those first-home buyers would have been renters of the properties investors buy, investors might face a bit more competition on the buying side and slightly fewer tenants on the rent side. However, even Australia's housing shortage, investors are unlikely to hurt for tenants overall. The rental market is so undersupplied that even a wave of renters turning into owners, perhaps 50,000 to 80,000 people, is a drop in the bucket nationally. One interesting angle, by helping more people buy rather than rent, the scheme could moderate rent growth over time. If you are a landlord, rampant price rises might boost your asset value, but if enough renters exit the pool, rental demand could soften a touch, easing the upward pressure on the rents. We are not talking a crash in rents. There are far too many rentals and too few rentals available, but maybe a slight rebalancing. In short, investors should watch how this plays out. Your existing properties might gain value, but acquiring new ones could become pricier, and the era of endlessly climbing rents might slow if home ownership rates ticks up. For renters on the sidelines, if you are renting and hoping to buy someday, this scheme is a double-edged sword for you. On one hand, if you can take advantage of it, it's a fantastic opportunity. You might become a homeowner years earlier than you thought possible. Many renters will see this lifeline and finally break out of the rent trap. On the other hand, if you are not in a position to buy yet, maybe you are still saving that 5% or your income isn't enough for a loan even with the 5% down, you could find yourself in a tougher spot. As we discussed, and influx of the buyers can rise prices overall. So the longer you wait, the more goalpost might move further away if the market heats up. It's a bit of a race now. Those who can will jump in quickly. If you can't, you might later face an even pricier market due to this very policy. The hope for renters who miss out is that the government's broader housing initiatives will increase supply and take heat out of the market in a few years. Also, if enough of your fellow renters become owners, that could slightly ease competition for rentals, possibly slowing rent hikes good for those who remain renting. Experts have pointed out that when would-be buyers are forced to keep renting, like under the old high deposit system, it pushes rents up and benefits landlords. So flipping that around, helping renters buy slowly eventually relieves some pressure in the rental market. Don't expect rents to drop overnight, but any improvement is welcome given the recent rental crisis. In summary, if you are a renter with a decent job with some savings, this scheme could be your ticket out of renting. You may feel more pressure quickly before prices climb. Either way, keep an eye on it and perhaps look into the programs like shared equity schemes or first home super saver if this one is the right fit. Let's tackle a common misconception about 5% deposit scheme. Myth: the government is covering the rest of my deposit or giving me free money. Fact: the scheme is not free cash, it's a loan guarantee. That means the government isn't paying 15% missing deposit. They are vouching for you to the bank so that you don't need to pay loan mortgage insurance. You still take out a loan of 95% of the property price and you're responsible for paying it back in full. If you default, the government will pay the bank the portion of the loan over 80% and then likely come after you for it. Why does this matter? Because you should approach buying with 5% down just as cautiously as buying with 10% or 20% down. Make sure you can afford the mortgage and not just at today's interest rates, but even if rates rise. The scheme makes it easier to get into a home, but it doesn't make the home any cheaper, as we discussed. So do your homework, budget for the true cost of home ownership, maintenance, insurance, possible rate hikes, and have a bit of financial buffer if you can. The last thing you want is to stretch to buy with 5% down, only to be stretched too thin financially. The scheme is fantastic opportunity. Just use it wisely, eyes wide, ballistic. If you do plan to use 5% deposit scheme, remember you're not limited to one or two big banks. Shop around for your home loan as enlisted a range of participating lenders, including smaller banks and credit unions to spread the benefit. You might find a better interest rate or service with a lender you hadn't considered. Since saving LMI is pointless if you get slugged with a high interest rate, compare your options. A difference of even 0.5% in interest can mean tens of thousands saved over the life of your loan. Take advantage of the fact that the scheme gives you choice. Don't just take the first loan offer you get. This way, you truly maximize the benefit of your low deposit breakthrough. The 5% deposit scheme is poised to shake up Australia's property market. It's a bold move with big promises and equally big questions. What do you think? Is this scheme your ticket into a home, or you worried it's inflating a new bubble? Let me know in the comments. If you found this deep dive helpful, please give the video a thumbs up so more people can discover this info. And don't forget to subscribe to our channel. We are going to keep unpacking the latest property trends and giving you the no nonsense you need for your Australian property journey. Hit that subscribe button and ring that bell so you won't miss out on our next explainer. We have got more in store to help you stay ahead in the market. Thanks for watching and see you in the next video. Stay informed and happy house hunting.